It is Tuesday, the 30th of May, 2017, and we had the lowest volume of the year today in the S&P 500 in a very tight range. It was generally, sellers in control as we lost 18 cents, but we're still well above that rising five-day moving average in any important level of support. I was just asked in the chat if this is indicative of summer trading in general, and I said no. I think it's just that this is the first week of summer, and there's a lot of people taking vacations now. So if we see it pull back, we're going to be looking for this bigger level to be our more important area of potential support. We've got the volume weighted average price from the gap down recently in that general area, which is rising up as well. And we've got the 10 and 20 day moving average. So we're still in an uptrend. It's a good time to not force trades. The market is sending us a message that we need to go slower. It doesn't mean that you look extra. I mean, you can always look extra hard, as I do, for ideas to bring you guys, but it doesn't mean you should be, trying to force trades and just make things happen, because that's how you get yourself into trouble. The Nasdaq did finish at another new all-time high here, and volume was a little bit better there in the Qs, but still, pretty anemic trade when you look at, all of it occurring really within the first couple minutes of the day, and then, kind of hanging on. So, we're above a rising five-day moving average, and we are innocent until proven guilty in the Nasdaq. The IWM, that is the Russell 2000, of course, is having trouble with the volume weighted average price from that recent gap down, and we closed just at it pretty much today, but also below the five-day moving average, which is declining. So on the intermediate term trend, that says we have to give it some caution, and on the bigger picture, we have to look at it and say, well, we're still in an overall trading range. The year-to-date volume weighted average price, we're back below that here today, but we've been crossing back and forth above and below it. So that doesn't always mean something, of course. More importantly, maybe, is the volume weighted average price since the election, and that is down near the bottom end of this range. So realistically, again, we're range bound in here, and if we see some pullback down into this area, then maybe that's something you want to trade, in the Russell 2000. But overall, it's in a primary range bound. The semiconductors are what's been driving the strength in the Nasdaq. The semiconductors, of course, lead the Nasdaq, lead the technology stocks, because in order to have a technology stock, you have to have semiconductors in it, and they are once again at an all-time high, showing that the short sellers are fools in there. The biotechs, however, did break down. As I pointed out in the midday video, the worst scenario would be for it to bounce from here, find resistance then at that volume weighted average price year to date, and then to continue lower. But when we back it up just a little bit deeper on the weekly time frame, we can see here, and just get rid of all this stuff, that we're right on top of the 200-day moving average as well. So I'm not expecting a collapse in this market. We've been in a big range for well over a year now, and this is that big range. So we're coming back towards, maybe, we're in the upper third of the range for the last year. Perhaps we continue down to the midpoint, but I think there's just really no reason to be involved in the biotechs. The financials are one area that, I don't talk about them a lot, of course, but this is something that I had drawn in a while ago on this group, and that is, we've got a declining 50-day moving average, and we've got a market that's been trapped really for a while here underneath the year-to-date volume weighted average price, hitting right over here and here, and then kind of back and forth above and below it. But we've been stuck below it for the last month or so, and as I pointed out a couple weeks ago, that this is what looks to me like a head and shoulders pattern, that if we come down and break through the bottom, through the neckline, let's say we were to break the neckline in the next 3 days, I think it would be foolish to sell short there. I would expect those people to be to get squeezed, and then if it rallied up and then began to pull back, then you would want to short it as it begins to decline again. We'll start to keep a little bit closer eye on the financials, but it's not still a focus. We've got the volume weighted average price from the recent gap lower over here, still below us. So this is going to be an important level in here, and maybe we're going to come down like this, and then we could either recover or continue lower. But the fact is, with it below the year-to-date volume weighted average price and below a declining 50-day moving average, you have to be very cautious about the financials and their potential implication for the S&P 500.